A very good morning to all of you. What do you mean by the capital structure ratios? As we discussed earlier, the capital structure ratio is a subtype of leverage ratio which tells us about the long-term solvency of a business entity. The first one being equity ratio. So the formula of equity ratio is equity share capital plus reserves and surplus less loss divided by the net asset. Net asset here is the fixed asset plus current asset less the current liability. Now what does this ratio tell us? This ratio tells us how much of the net assets of the business has been funded by the owner's equity. The second one, that brings us to the second ratio, which is the proprietary ratio. This ratio in the numerator not only takes into account the equity share capital, it also takes into account the preference share capital. So the formula of proprietary ratio is equity share capital plus preference share capital plus reserves and surplus, which is usually excluding fictitious assets and losses, divided by the net assets. So it tells you how much of the net assets have been funded by the shareholders. The third one is the debt to equity ratio. So the debt to equity ratio is total outside liability divided by tangible net worth, or term liability divided by tangible net worth. So what is tangible net worth? Tangible net worth is your total capital, equity share capital, preference share capital plus reserves and surplus less loss. That is divided by, that is the denominator. And in the numerator part, you either have the total outside liability, that is the term liability, and the current liability, or else you can also take into account only the long-term liability, that is the term liability. So what does the TOL by TNW or debt equity ratio tell us? It tells us how financially solvent is the company to service its interest from the total capital. So it is inversely proportional to the long-term solvency. Higher this ratio, lesser is the long-term solvency of the company. The fourth ratio is the debt ratio. Debt ratio is total outside liability divided by the net assets. This ratio again is inversely proportional to the long-term solvency of the company. Now, the last ratio being the capital gearing ratio. This is preference share capital plus debentures plus borrowed funds divided by the equity share capital plus reserves and surplus less losses. This tells us the proportion, the ratio between the owner's fund and the borrowed funds. So this is a gist of the leverage ratios. The subtype of leverage ratios, that is the capital structure ratios. Thank you.